Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into the world of corporate filings. Today we're cracking open Marpai Incorporated's latest Form 10K, their yearly report. Get ready for some twists and turns because this report has more red flags than a Formula One race. Marpai is a bit of a fixer-upper in the healthcare world. Let's find out if they are a fixer or a broken record. This report covers their performance for the year ended December 31, 2024. So let's jump right in. The headline, they're still struggling to turn a profit, and there's a warning about whether they can even stay in business. That's right, their independent auditor is raising a big red flag. This means there's significant concern about Marpai's ability to continue operating for the next year. If they can't get more money or sell off some assets, they might have to scale back operations or even shut down entirely. Another major challenge, they've had trouble keeping their customers. In 2024, about 25% of their clients left. While they are taking steps to fix this, there's no guarantee they'll be able to turn things around. If they keep losing customers, their revenue will suffer and it will be harder to attract new ones. Marpai is also dealing with multiple lawsuits and they expect more in the future, which could take up money, time and attention from senior management. They also need to maintain regulatory approvals and licenses to operate their TPA business, which means third-party administrators in different states. Failing to do so could negatively affect their business. These are just a few of the risks they highlight in the report. It's a long list covering everything from competition and data security to government regulations and potential problems with their technology. It is worth taking a look if you are planning on investing. Shares trade on the OTCQX market under the symbol MRA. What does that mean? Well, as of May in 2024, Marpai's common stock was suspended from trading on Nasdaq and began trading on the OTCQX, which is a over-the-counter market. And this shows a rocky year and is never a great look for attracting new or holding onto existing investors. Although they believe that the services they offer their clients are differentiated, they operate in a highly competitive market, which means they are not sure if what they offer is unique enough for business. Let's get into some financial specifics. Their total revenue decreased from $37.2 million in 2023 to $28,000. It's like losing almost 1 in 4 customers. Cost of revenue also decreased, which is good, but it was just in line with the decrease in revenue. They did manage to cut general and administrative expenses from $19.2 million, mainly by aligning their TPA operations. These TPAs, or third-party administrators, are very costly but important to manage and keep operating. It is good to see they are working on becoming more efficient. Sales and marketing also took a hit, decreasing by $48 million, mainly from actions taken to align the two TPA companies. Their expenses related to how their facilities are set up also decreased, as well as reduced costs for depreciation of their assets. There are no new assets to report. This is not good. The company determined that their goodwill and intangible assets were fully impaired in June 2024, which forced them to write down $7.6 million. To try to say that in plain English, because of how much the company lost value, it had to completely rewrite that some things it had on the books related to value, and they just don't have value anymore. One last thing, in good news, though small, their loss from foreign exchange went from $26,000 to $1,000. So, although small, their international business is gaining efficiency. Adjusted EBITDA, which basically shows how profitable they are from core operations, was a negative $9.1 million, a much better result than the negative $20 and $20.4. Net cash used in operating activities, basically how much money you are bleeding by keeping the lights on and trying to operate, was $15.27 million. To try to stay afloat, they took several measures to try to get more cash. For example, one interesting way was through the sale of future cash receipts on accounts receivable, which made $1.5 million. Management continues to evaluate additional funding alternatives and is seeking to raise additional funds through the issuance of equity or debt securities. Effective May 29, 2024. Their common stock was suspended from trading on Nasdaq and their common stock commenced trading on the OTCQX. Director Mohsen Nowazami's relationship with Safe Capital and its investments. The CEO and CFO are ultimately responsible for reporting and disclosure. On the good news front, at least so far, cybersecurity threats, including any previous cybersecurity incidents, have not materially affected the company. Finally, Urasheld will continue as accountant despite substantial doubt about the company's ability to continue as a going concern. And there's a legal fine print point to take note of. Any lawsuits need to be brought in Delaware. which might limit stockholders' ability to bring a claim in a judicial forum that it finds favourable for disputes with us. Okay, that was about it. A lot to unpack here. So what's my take on Marpai? It's a mixed bag, to put it lightly. They made progress in cutting costs and improving efficiency, but they're still losing money and struggling to keep customers. The big red flag from the auditor about their ability to continue operating is a serious concern. It really looks like a ship that has many holes in it, and if it can't stop them quickly, it will sink. Their strategy of using technology and AI to improve healthcare outcomes is interesting, but it's not clear if it's enough differentiate them from the competition. And the fact that they had to move from Nasdaq to the OTCQX market is definitely not a good sign. There are several ways that the team is trying to get more cash, such as using existing debt and using more, which is a major concern considering how much debt they already have. It all comes down to whether they can successfully execute their strategy and turn things around. But for now, it looks like there's still too much uncertainty and risk. And because of this reason, I'm personally going to pass on investing in Marpai. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives.